Right, in this exam, we have some information on Disney. We have its stock price, beta, some balance sheet information, some income statement, cash flow statement, and some other assumptions. What is Disney's current enterprise value? All right, so we're gonna need a couple of things for that. We're gonna need Disney's market value. So market value of equity. Actually, move it down here. Market value of equity, that's just the share price times the number of shares outstanding. And this is going to be in billions of dollars. Let's make that red. And then we need net debt. We can just calculate that on the fly here. So Disney enterprise value is the market value of equity plus the market value of debt, which we just take as the book value of debt minus cash, so that we have a net debt, and the market value of equity is, sorry, the enterprise value is 208 billion. What is Disney's current book to market ratio? So let's calculate the book value of equity. So book value of equity, well, that's just going to be total assets minus total liabilities. It's right here. So let's make that red. And the book value to market is going to be book over market. And it shouldn't be formatted as a number. So as a currency, it should just be a number. 0.63. In the current S&P 500, the book to market is 0.25. So the book value on average in the S&P 500 is only a quarter of the market value. In the case of Disney, the book value is like 60% of the market value. So relatively speaking, Disney appears to be a value stock. What is Disney unlevered beta? Well, that's just its levered beta, just the beta we get from regressing Disney's return on market return. But now we have to scale it, and we have to scale it by 1 plus, and we use market values. So we're going to scale it by debt over a market value of equity. And that gives us 1.01. Does that make sense? I'll just change this to a number again. Make it red. Does that make sense? Sure. If there was no debt, then the unlevered beta would be equal to just the levered beta. But because there's a debt, the actual asset beta is less than the equity beta. Fantastic. What is Disney's cost of equity? Well, that's just a formula that takes the risk-free rate plus the levered beta times market premium. Right there. Let's format that as a percentage. Let's give it a decimal space, make it red. Fantastic. What is Disney's WACC? Let's do that in one formula. We're going to have to calculate after-tax cost of debt, but let's do that. Let's first do weight of equity. So that's the market value of equity divided by market value of equity plus total debt times the equity cost plus total debt divided by total debt plus market value of equity. So that's our weight on debt times the pre-tax cost of debt times 1 minus the tax rate. It's going to give us after-tax cost of debt, and that gives us, let's format that as percentage again. Let's give it a couple more decimal places, make it red, and that's Disney's WACC. Using the information about what is Disney's net income, let's do that. Well, let's just take revenue and minus COGS minus SG&A minus interest expense minus taxes. Do I have it all? Minus taxes. That is going to be net income. 3.6 billion. Let's calculate Disney's free cash flow. So sure, we can start with net income, and to that we know we have to make non-cash expense adjustments. So that would be, we're going to add depreciation. We're going to subtract CapEx. We're going to subtract change in net working capital. In this case, they actually decreased net working capital. So it's going to improve our cash flow. And since we're looking at free cash flow, the cash flow that's available also to debt holders, we're going to add interest expense. That's 5.8 billion. That's Disney's free cash flow. We could have probably gotten there another way. We could have done calculate EBITDA. I don't know if I should do that here. Sure, let's do this on the side here. Let's calculate EBITDA if we want to. So EBITDA would be just revenue minus COGS minus SG&A, but plus depreciation. That's EBITDA, right? And then from EBITDA, if we wanted to get to free cash flow, we can just take EBITDA and subtract. Well, yeah, subtract taxes because we have to pay taxes, and subtract CapEx, and subtract net change in net working capital, and it's going to give us the same number. Okay, 5.8 billion. So we're good. We've got free cash flow. If free cash flow grows at 4% indefinitely, what is the enterprise value? So that's just the present value of this number times growing at 0.04. I should probably make that a cell, but for now I won't. Divided by the difference between the discount rate that we apply, which is WACC, minus 0.04. And so this doesn't count the 2022 free cash flow, right? We're calculating the enterprise value as of January 1st, 2023, going forward. So that gives us 116. Let's make fewer decimal places. Okay, 116 billion. Given the assumptions above, what do you think is the intrinsic fair price, stock price? So let's do the intrinsic EV is this guy here. Let's do net debt is total debt minus cash, and then so this will give me intrinsic value of equity will be the difference between these two. This minus that, and then share price is going to be just that divided, really intrinsic share price I should write, divided by the number of shares outstanding, and that gives me 43. So let's fewer decimal places. Let's make that red since we all calculated that. I can add intrinsic. All right, so that's how much Disney should be worth if I use this cash flow, and I assume that it grows 4% indefinitely. I discount it at WACC. I get this is my EV, subtracting net debt. Intrinsic value of equity is this much divided by shares outstanding, gives me the stock price of $43. So it looks like right now Disney seems very overvalued. I can create a sensitivity analysis of the effect of market premium and capital expenditures on the calculation of fair price. So let's do cap X on in the columns. So capex right now we're assuming 5 billion. So let's do a sensitive analysis. What if it was lower? 5 or 6. So 5 is the middle. Market premium. Right now we're assuming. All right, so I actually need to shift this down a little bit. Right now we're assuming market premium of 6. So what if it was 5, 6, and then 7? The cell that we want to calculate, the cell that we're interested in is here. That's the intrinsic price. Let's highlight this table. Go to data. What if analysis, data table, the row input cell is the market premium, which is right here. The column input cell is capital expenditures, which is here. I'll say okay to that. And did something wrong. Oh, I know. This market premium needs to be 0.05, 0.06, 0.07. And clearly, if I'm in the baseline, what's the number of decimal places? If I'm in the baseline scenario, that's the one in the middle, where capex is 5 billion and the market premium, sure, let's make that a percentage, is 6%. Then the fair price is $43. If I assume a higher market premium, more risk, I discount at a higher rate, then the fair price is actually a lot lower. If I assume more capex, then I have less free cash flow, and the price will also fall. All right, fantastic. What if free cash flow grows at 2% for the next 4 years? but then grows at 4% indefinitely. How does this affect your calculation of fair price? So I created myself a lot of space here. So let's do this as efficiently as possible. How about we do 20? Sure, let's do 22 here, and we'll do 2023. Said 4 years, so that should be enough to. No, 4 years, so that's one more. Control R. And free cash flow that we start with in 2022 is this guy here. We're going to grow it at, and actually, let me make that a formula. Okay, so I'll say first 4 years, I'll make that 0.02%. Let's turn it into percentage. That's fantastic. And we'll do this guy times 1 plus the growth in the first 4 years. And I'm going to lock it with F4. And I should be able to Control R that. That's how fast the free cash flow is going to go. Let's make that just 2 decimal places. That's growing at 2%. Very good. So this is free cash flow. Then let's do the discount period. We're going to discount this guy at 1. And here, +1 at 2, 3, and 4. And so we'll do PV of free cash flow. And so that's going to be the cash flow divided by 1 plus, and we're going to use WACC. Where's my WACC? Right here. And I'm going to lock my WACC with F4. C33, is that what it is? Yeah, C33. And I'm going to raise it. And I don't need to put parentheses because the exponentiation is going to take place first. So I'm going to raise it to this just one time, discounting it just one time. I'm going to Control R that. Let's see, does that work? That's makes sense because I'm discounting at a higher rate and then it's growing, so it's actually going down. We can make fewer decimal places. Let's calculate the terminal value. So the terminal value will be, as of 2026, the terminal value will be the last free cash flow that's going to grow at 1 plus 0.04. Should make that a cell too, but just hard coding 0.04 for now, divided by my WACC, which is here, minus 0.04. Because after these 4 years of Disney is still struggling, the cash flow is going to go faster, 4%. But before the first 4 years, it's going to go at 2%. So I'm going to hit enter, and that's my terminal value as of 2026. Of course, I need to calculate the present value of the terminal value. So sure, let's do that. PV of TV, and that's going to be, it's going to be discounted 4 times. So I'll do this divided, oops, not divided, yeah, divided by 1 plus my WACC. here raised, because that's gonna do, just put a 4. Now let's say enter to that. And that's the present value. So today's value, that's 126. So then I need the sum of PV of free cash flow of these first 4 years. 4 years, and that's just sum of these numbers right here. All right, that gives me 19, adding them. So I'll have EV, intrinsic EV is giving me, I'll just do alt equal now. So fine, I'll do this. Oops. I'll do equal of this number plus this number, right? The terminal value plus the first 4 years, present value of the free cash flow in the first 4 years, and I can get my price, intrinsic price, and that's going to be the, oh no, I need that's the total EV. Price is going to come after. So let's do intrinsic value of equity. It's going to be this baby minus net debt, which is total debt plus cash. Right, so it's a net debt. And great, and I can take that number and divide it by the number of shares outstanding, and that gives me a new stock price, new fair stock price, which is not surprisingly lower than when we were assuming that the growth will be 4% forever. Let's actually check our math, because if I change the first 4-year growth from 2% to 4%, I should get the same number that I had got earlier, and I do, and that is awesome. Okay, now we have a couple of narrative questions. I encourage you to look at the typed up solutions, and essentially here the answers can vary, but we see how much goes into the calculation of the fair price. It's the growth rate, it's the discount rate that we use. So it's possible that the market thinks Disney is going to grow faster. It is possible that the market is using lower market premium. It's possible that the market is using a lower risk-free rate. It's also possible that market is calculating different free cash flow going forward. Then maybe they assume a few lower capital expenditures, and that's why they get to a higher price than what we got. In terms of financing acquisitions using debt, we saw that debt in the presence of taxes has some advantages. Actually, increasing leverage can increase the market value of the company. In the case of Disney, looking at their cost of debt, it's actually pretty low. So pre-tax, it's only 5. Given their high tax rate of 30%, after tax, it's even lower. So there, the benefits of financing something through debt are pretty high, especially given that their beta is relatively high. So the gap between the cost of equity and cost of debt is pretty high. That makes debt financing that much more advantageous. Okay, let's do part 2. In part 2, we've got portfolios of small stocks and large stocks. Every June, we sort all the stocks in by size, by market capitalization. The smallest 30%. We calculate the return on that smallest 30% of stocks from January to December. We do the same thing for the median and for the high stocks, or high meaning large stocks. And here I want to know what would be the return on a portfolio that's equally short large stocks and long small stocks. So that would be, I can call it really low minus high. I'm gonna ignore the stocks that are in the middle. I'm just gonna go long these guys and short these guys, and that would be my return. Let's see if that makes sense. Well, I lost money on the ones that I was long, but I gained some money on the ones that I was short because they also declined in price. On net, I still lost money because the stocks that I was long in dropped by more than the stocks that I was short. So let's see how that evolved over the next 2 decades. Control D. Sure, let's make that a percentage. So let's calculate the average return on this. Go and arrow up. It's 1%. It's positive. That's good news. So we would have made money on that strategy. Let's see if we would make money given the risk of that strategy. Meaning, let's calculate if this portfolio generates alpha. We know that to calculate alpha, we need to regress the return of the portfolio on the excess market return. I mean, we should really regress the excess return on the portfolio, so return on the portfolio minus risk-free. But since this is a zero-cost portfolio, we're already subtracting the risk-free rate. There's no opportunity cost of leaving money, putting money into the risk-free rate. So we can take, let's do just the beta coefficient and alpha coefficient and the standard error. I like to use the lin-est function. This is my dependent variable, the return on the portfolio. The independent is the excess return on the market. And I'm gonna say I want the intercept to be calculated. So slope is calculated normally. And so that's true. And I also want some all the additional regression statistics. So that's true as well. And I should see, well, this is my beta, this is my alpha, this is the coef, and this is the S standard error. I can calculate the t stat on this, which is just the coefficient divided by the standard error. And I can see that the t-stat on alpha is pretty low. It's not statistically significant. It's positive alpha. So this strategy generated alpha, but that alpha is not statistically significant, which supports efficient market hypothesis. We really can't consistently make money by simply buying small stocks and shorting big stocks. So this result supports efficient market hypothesis. looking at how this strategy performed over time, we could certainly just eyeball these returns. What we did in class earlier, we actually calculated a return on a strategy where we put $1 long into the small stocks, dollar short of the big stocks, and then accumulated our gains and losses. So we can do that here. So we're going to start with 0 money, and to that we're going to add 1 plus the return on the stocks that we go long. So in this first year, we would actually lose money. And from that, we're going to subtract 1 plus the return on stocks that we short. So there's a minus in front of that. And so that first year, yes, we would lose money, but let's see how that goes over time. I'm going to do Control D on this. And I see that at the end, 22 years later, actually 32 years later, I would have made money. I would be up 40 cents, which is just not bad. But over time, just looking at this, you can see that periods where I'm deeply negative, then it goes as high as like 73 cents, but then starting 2013, it just goes down.